Thank you for staying with us. As we walk into it this morning, don't get excited about that FDIF buy figure. Yes, DIs were large buyers in the cash market yesterday, but that was only because of the Shri Ram transport deal. You strip that out, you can't get the absolute number, but if you strip that out, the number may not look all that impressive. In fact, the biggest irony for our markets is that right now the list of what could go wrong is a pretty long one. Globally, it's about trade war. Locally, it is slowdown. What will happen to Yes Bank? How DHFL saga will continue or move? And what is the future for some of the NBFCs which up until now have been borrowing from the wholesale market and lending in the retail market? That is the picture, or that is the liquidity picture, which just tells you that after that bumper March, when we got record inflows, the month of June has been quiet. Devang Mehta, 23rd of May, when Prime Minister Modi got re-elected, everyone thought that India's moment in the sun had arrived. The bulls were thumping the table with the view that a stable mandate means good news for the market, and the market should go higher, and the markets will go higher, and markets will not correct. But look at what's happening.
Good morning, Nikunj. Thanks for having me on the show. I think, yes, clearly after 23rd, the sentiment had turned, I can say, quite positive. But what has played out after that, one after one, the accidents which were happening earlier are not finding any, I can say, a conclusion which is positive for the market. So right from, as you were rightly mentioning about starting from IL&FS to DHFL to the Yes Bank saga to in fact even Jet Airways, I can say that there are so many accidents happening even within the Nifty stocks that you go outside and look at what's happening to mid caps and small caps. The consensus trade after the election results, after the thumping victory that the government got, I think the clear mandate was to buy mid caps and small caps, which has not played out. In fact, if you look at the last 1 month trade, a lot of mid caps and small caps, in fact, because of the prevailing liquidity situation and whatever the FIs want to put in money, of course, we have seen not great inflows, but whatever they want to buy market leaders, or they want to buy something among the top 5 or 10 stocks, which probably has been the story in the last 1.5 years. And that has continued even after elections. So now what we are seeing is again a polarized market, mid and small caps probably not going up. Now people expecting something from the monsoon, people also expecting that government would come up with stimulus in the form of consumption boost for the budget. There would be something which would be put in the hands of the consumer, something in the hands of the farmer, how they would find a solution to the NBFC crisis. I think all these are questions which are unanswered. So yes, markets are temporarily experiencing sort of a jolt in the wake of no good news. Trade war also, as you rightly said, is also an impending issue with India. But yes, one thing that crude probably trading around 60 is a bit of positive. And the next 5 years we have a stable government in place. It's again a positive. So my sense is yes, this can be a correction which can still last for 3-4% more. But yes, you have to find your opportunities in this type of correction.
We are addressing the entire HDFC AMC move, where they have decided to use their own balance sheet to give liquidity to some of the unit holders of FMP. Dhirendra Kumar, this is Devang, do you track JSW Steel? I mean, for the longest time, bulls have defended this one by saying that, look, this is a converter, and if you buy a converter, you don't run the risk of commodity cycle.
In fact, yes, it's been one stock which has sort of always not followed the trend rather. So the sense here is that probably the times are now such that globally also there is a big slowdown which everybody is facing. And while we talk about rate cuts, which is good for the liquidity situation for us, but overall, if you see through the slowdown, I think it's very difficult for such cyclicals per se metals to do very well. So if you look at a lot of numbers of say Tata Steel or even other metal counters, I think it's going to be increasingly difficult to justify how they would sort of go up from here. Valuations, and of course if valuations don't go up, even the price points would be difficult to go up. So my sense is yes, JSW can probably defy the trend for some time, but we wouldn't like to touch metal counters at this point, looking at the global volatility. A lot of domestic centric plays are getting inexpensive by the day, and probably if there is a correction which we experience in the next, I can say 1 month or 2 months, there are a lot of domestic centric stories which would appeal to us rather than anything which is more global or where we don't have the wherewithal to understand it in a sort of a sound manner.
Apollo Tyres. Now, Apollo Tyres, we are talking at a time when we know there is a painful and a visible slowdown in the auto sales. Auto sector is slowing down. Everyone in a sense is feeling the heat. The last 1 year, Apollo Tyres has taken a knock of about 26%. If you compare Apollo Tyres with, let's say, Seat, or for that matter, if you compare Apollo Tyres with an MRF, you know, the fact that they've had the global exposure, which sometimes has been, which in a good global growth environment has worked for them, but in a very choppy global environment, I think that whole thing has been, you know, painful for them. MRF is down 26% in the last 52 weeks. Seat is down 28%, and Apollo Tyres is also down 26%. So the thing with tire stocks is that even though they try to differentiate themselves, market hardly differentiates themselves when it comes to the price action. Devang, tire stocks, if somebody buys them, should one focus on the bad news coming from autos or good news coming from crude and good news coming from the raw material side?
I think here is a time where you are seeing auto stocks getting hammered. Auto ancillaries, of course, is a story which depends upon the auto, and it's sort of played as a proxy when you see that the auto sector is doing well. My sense here is, why not take direct exposure to auto stocks which have seen huge correction? Just not recommending, but just giving examples for companies like Maruti, for companies like Eicher. The world's not coming to an end. Of course, I know there are problems, and the statement would look a little more superficial in the prevailing slowdown where we have seen the last 6, 7, 8 months of big demand slowdown, and 1 quarter more can probably be a little bit of a extended slowdown. But my sense is a company like Maruti or a company like Eicher who own market share in the respective sort of segmentation, I can say that why not buy this when they are getting inexpensive by the day. Of course, there will be time when auto ancillaries would also play out to be larger stories, but a lot of these tire companies, as you rightly said, are also dependent upon the global demand. Of course, the OEM demand has been slack. The replacement demand probably does not slow down big time. But my sense is, yes, to answer your question, first we would buy the auto stocks for a couple of years horizon, and then something in the auto ancillary. Yes, couple of tire stocks will look good here also. Even some auto components which have seen huge correction, companies like Endurance Technologies also look quite sound for a 2-3 year horizon.
My heartiest congratulations to ET now on completing the